It is Saturday, January 31st, 2026. And I have to be honest, looking at the markets this morning, specifically the real-world asset sector, I feel like I'm looking at two completely different realities superimposed on top of each other. It's really disorienting.
It's a bit of a schizophrenia moment for the market, isn't it?
Exactly.
You have the signal, and then you have the noise, and right now the noise is just... it's deafening.
Schizophrenia is the perfect word. We are doing a deep dive into Ondo Finance today.
Yeah.
And if you just look at the headlines, the corporate press releases, it feels like champagne should be popping everywhere.
Oh, absolutely.
You've got BlackRock, you've got State Street. I mean, the literal plumbing of the global economy, partnering with them. Their total value locked just cracked $2.5 billion.
Which is an all-time high, and not just by a little bit, by a significant margin. If you were looking at a revenue chart for a traditional startup, you'd be buying calls with both hands.
Right, no question. But then you switch tabs. You look at the price chart for the actual Ondo token.
Yeah.
And it is, well, it's a bloodbath. It's down to the 28-30 cent range. It's down so much in just the last 2 weeks.
A huge drop.
It looks like a rug pull, but the fundamental data, the adoption data, looks like a blue chip.
Mm-hmm.
How can both of these things be true at the same time?
It's the ultimate divergence. I mean, this is what traders look for. The fundamental signal is pointing straight north, but the price signal is pointing due south. And usually, in efficient markets, that kind of gap closes pretty quickly.
Okay, so the question is, which direction does it close?
That's the multi-billion-dollar question, isn't it? Does the price eventually catch up to the fundamental value, or was the value a mirage all along, and the price was telling the truth?
So that's our mission for this deep dive. We need to figure out which signal is fake. Is Ondo just another crypto token, a falling knife that's about to get diluted into oblivion? Or is this the kind of buying opportunity that people will look back on in 2030 and just kick themselves saying, how on earth did I miss that?
And we have a pretty hard deadline to figure this out because there is a huge catalyst coming up. The Ondo Summit is in just 3 days, February 3rd.
In New York City.
In New York. Hmm? And that summit is going to be the event that forces one of these narratives to break. The market won't be able to ignore it.
The guest list is just, it's insane. We'll get to that later on.
Yeah.
But I think we have to start with the ugly part first. The elephant in the room.
The unlock.
The token unlock. Because I think a lot of retail investors, they see the word unlock and they just panic, but they don't actually know the mechanics of what happened.
No, they just see a big red candle and run for the hills.
Right.
But the January 18th event, that is the primary driver of all the pain we're seeing right now.
Okay, so walk us through this, because token unlock sounds kind of bureaucratic and boring, but the effect on the price was just violent. What exactly happened on January 18th, 2026?
So to really understand the violence of that price move, you have to understand the mechanics of Ondo's supply structure. Before January 18th, the token had a relatively tight float. Right. Tight float, meaning not many tokens were actually available to be traded.
Exactly. A huge portion of the supply was locked up in these things called vesting contracts, which are essentially digital handcuffs for the early investors, the team, the VCs who backed this project years ago.
Right, the people who got in at, pennies on the dollar. Or fractions of a penny, probably.
Fractions of a penny, absolutely.
Yeah.
And this wasn't a linear vest where they get, say, a tiny bit of their allocation every day over 4 years. That's manageable. This was a cliff.
A cliff.
A cliff.
Yeah.
Which means on January 18th, the handcuffs came off for a huge, massive tranche of tokens all at once.
Yeah.
We're talking about 1.94 billion tokens hitting the circulating supply instantly.
I saw that number in the notes, and I tried to do the math just to visualize it. 1.94 billion. It's almost hard to comprehend a number that big hitting a market.
It's huge. And a lot of people will say, oh, but that's only about 19% of the total supply. But that's a really misleading metric because most of the total supply isn't moving. It's in the Treasury. It's for future ecosystem rewards, whatever. So that's not the number that matters.
No. The number that matters for price discovery, for what you see on your screen, is the circulating supply. And this single unlock event increased the amount of tradable tokens. The tokens actually available to be bought and sold on an exchange by somewhere between 57 and 61%.
Wait, hold on. Just so I'm hearing this right. The supply of tradable tokens didn't just go up a little. It increased by 60%.
In a single day, overnight.
Wow.
Basically. Imagine you're a trader who deals in rare baseball cards. You know there are 100 Mickey Mantle rookie cards in existence, and the market has priced them accordingly.
Okay.
Then tomorrow morning, a warehouse you didn't know about opens up and dumps another 60 pristine Mickey Mantle cards onto the market. Even if the card is still legendary, even if Mickey Mantle is still the G-out, basic economics says the price has to adjust.
You need 60% more capital, more buyers, just to keep the price flat.
Precisely. And that capital just wasn't there waiting on the sidelines. It was a massive liquidity test, and the market failed it.
Okay, but here's the part I don't quite get. If these VCs and early investors, if they really believe in the long-term vision of the project, and clearly the project is doing well with all these partnerships, why are they selling? Why not just hold on for the $10 price target everyone talks about?
Yeah,
it feels like a vote of no confidence from the insiders.
See, that's the classic retail interpretation. Oh, the insiders are dumping on us. It must be a scam. But you have to try and look at it from the structural reality of a venture capital fund.
Okay.
These funds have a fiduciary duty to the own investors. They're limited partners, they're LPs. They invested in Ondo years ago at a valuation that was probably, a few $1 million.
Right.
They are sitting on a massive, life-changing multiple. Even with the price at 30 cents, they have to rebalance their portfolio. They literally can't, from a risk management perspective, have 80% of their entire fund's value tied up in one single volatile crypto token.
So it's not malicious.
Yeah.
It's mechanical. It's a business decision.
It's largely mechanical. It's portfolio management 101. They have to take profits, return capital to their LPs, and move on to the next investment. But the market doesn't care about why you're selling.
It just sees the sell orders.
It only cares about the depth of the order book. And right now, the buy-side depth was just not there to absorb nearly 2 billion tokens without the price buckling under the pressure.
And we saw that happen immediately. The price just nuked, what was it, about 16% right after the unlock.
A very sharp, quick drop.
But here is what really worries me. That was almost 2 weeks ago. Why are we still bleeding out? Usually you get the big dump and then the bargain hunters come in and you get a bounce. We haven't gotten that bounce.
That's what we call the overhang effect. It's a very real psychological phenomenon in markets. It's not just about the initial dump. It's the fear of the next sell order. It psychologically breaks the market's momentum.
The fear that there's more to come.
Exactly. And we saw a specific data point in the on-chain analysis that really illustrates this fear perfectly. There was a whale, a pretty large entity, who tried to be a hero and buy the dip on January 26th.
Oh yeah, I saw this in the research stack. They bought a huge amount, something like $14.3 million worth.
Roughly, yeah. A huge buy. They stepped in around the mid-30-cent mark, probably thinking, okay, the worst of the VC selling is over, the weak hands are out, time to catch the falling knife.
What a brave move.
A very brave move. And today...
How are they doing?
Today, as of this morning, they are sitting on an unrealized loss of about $1.5 million.
Ouch.
And that matters for everyone else because that whale is now a prisoner of their own position. They're what we call an underwater bag holder. If the price ticks up a little bit, say to 34 cents, they aren't going to be thinking, great, now I'll hold for the moon.
No, they're going to be thinking, thank God I can get out at break even.
Precisely. They are likely going to sell to break even or at least minimize the damage. And that creates a ceiling.
A massive wall of resistance.
It's a huge wall. Every time the price tries to recover, you have all these underwater bag holders who are just looking for an exit. That's what we call churn. The market has to literally chew through all of that sell-side supply and transfer the tokens from the weak hands, the VCs cashing out or these underwater whales, to the strong hands, the new believers who are buying for the long haul.
And that digestion process, that churn, that takes time.
It can take weeks. It can take months. It's boring. It's painful. And it's designed to shake out absolutely everyone who doesn't have extremely high conviction in the project's future.
Okay, so that's the bear case.
Yeah.
It's actually pretty simple when you break it down. It's just supply and demand, too many tokens, not enough new buyers, and a lot of underwater positions that are acting like gravity on the price.
That's a perfect summary of the bearish argument.
And if I stopped reading right there, I would sell everything I had and walk away. But then I look at the usage data, the actual business metrics.
And that is where things get really weird. This is why I called it a paradox at the very beginning.
It's a complete paradox. Because usually, when a token's price drops 30 or 40%, it's a death spiral. Users get scared and leave. The total value lock, the TVL, it plummets because people are afraid the protocol is going to zero.
Right, capital flees to safety.
But Ondo's TVL is doing the exact opposite. It's not just stable, it's going parabolic.
Absolutely parabolic. We just hit $2 billion in TVL this week.
That's a record.
A record high. And if you zoom out, that is up over 350% year over year.
So let me get this straight. The price of the stock, which is the ONDO token, is crashing. But the revenue and the assets under management of the company, the protocol itself, are skyrocketing.
It's the classic Amazon versus Pets.com moment from the dot-com crash. Back in 2000, everything went down. Good companies, bad companies, it didn't matter. But the companies that were actually building real infrastructure, like Amazon, they eventually decoupled and went on to dominate.
And the ones that were just hype, like Pets.com, went to zero.
And stayed there. Ondo is very clearly in the camp of building infrastructure. They aren't building another crypto casino. They are methodically building a bank.
Let's dig into that infrastructure.
Yep.
Because we throw around these big names like BlackRock and State Street, and you know how it is in crypto. People tend to exaggerate partnerships. It's like, oh, we use Google Cloud, so we're partners with Google.
Right. We use AWS for our servers, so Amazon is our best friend. That's the classic crypto hype cycle playbook.
Exactly. But this isn't that. This feels different. I want to spend some real time on the State Street deal, specifically this sweep fund, because State Street isn't some degen trading firm. They are as TradFi as it gets.
This is monumental, and I genuinely don't think the market has priced this in at all. You have to understand who State Street is. They aren't a trading firm. They aren't a bank in the way you think of Chase. They are a custodian.
A custodian.
They hold the assets. They are the vault for the entire global financial system. We are talking about tens of trillions of dollars in assets under custody. They are the literal definition of risk-averse.
They are the vault. So for a company like that to partner with Galaxy Digital and specifically integrate Ondo, that implies a level of due diligence and regulatory scrutiny that most crypto projects could never, ever pass.
It's a stamp of institutional approval that you simply can't buy. You can't pay for that kind of validation. But let's get into the mechanics of the sweep fund, because it's not just a press release. Ondo is the seed investor.
I saw that. They're planning on putting $200 million of their own treasury into this fund.
$200 million?
Why? Why would they lock up that much of their own capital? That seems like a lot of money for a startup to just commit to something like this.
To prove the utility. To bootstrap the liquidity. They're eating their own cooking. The sweep fund is designed to solve a very specific, very boring, but very, very expensive problem for big finance. The weekend problem.
The weekend problem. I haven't heard that term.
Think about it from the perspective of a multi-billion-dollar hedge fund. It's Friday, 4:00 p.m. Eastern Time. The stock market closes. The bond market closes. The Fed wire system, which moves all the big money, it closes.
Okay.
If you're a fund and you have, say, $100 million in cash sitting in your account, that money is effectively dead until Monday morning at 9:30. It's earning zero yield.
Just sitting there.
Or worse, imagine a scenario where the crypto markets have one of their classic Saturday night crashes, which they often do.
Right, because crypto is 24/7.
Exactly. So if you're a big trading firm and you get a margin call on a Saturday night and all your cash is stuck in a State Street bank account that won't open until Monday morning, you are liquidated. You go bust.
Even though you have the money.
Even though you're completely solvent. You just can't move it. You're solvent but illiquid, which is a terrifying place to be.
That is a nightmare scenario.
It happens all the time. The sweep fund solves this. It uses PayPal's stablecoin, PYUSD, to allow for 247 subscriptions and redemptions. It bridges the gap between the 9-to-5 TradFi world and the 247 crypto world. It lets that hedge fund keep earning yield on their cash on a Saturday or move $50 million on a Sunday night to cover a collapsing position.
So Ondo is essentially paying $200 million to seed the bridge that lets institutional capital finally move at the speed of the internet.
Correct. And they are making a bet. They're betting that once these big banks and hedge funds get a taste of 247 liquidity and instant settlement, they will never want to go back to 9-to-5 banking. It's like going from dial-up to broadband.
Still go back.
You don't go back. And that brings up the other B word, BlackRock. Ondo is the single largest application recipient for BlackRock's BUIDL fund. Again, let's strip away the marketing hype. What does that actually mean for the plumbing of this system?
Yeah, what's the tangible benefit there?
It means that Ondo isn't trying to replace Wall Street. They are building on top of it. You know, a lot of the early DeFi ethos was very cypherpunk, burn the banks.
Right, be your own bank.
Ondo's strategy is onboard the banks. By using BlackRock's BI deal fund as the underlying asset for their products, like OUSG, they're essentially backing their tokenized treasuries with BlackRock's own treasury management expertise and infrastructure.
Which massively de-risks it for the end user, for the institution.
Massively. If you're a corporate treasurer at a Fortune 500 company, are you going to put your company's spare cash into some anonymous DeFi protocol like SafeMoon?
Absolutely not. You'd be fired.
You'd be fired immediately. But are you going to put it into a tokenized product that is custodied and managed by BlackRock? Maybe. It removes that smart contract risk fear that keeps almost all institutional money on the sidelines.
It's the moat that everyone talks about.
It is a massive regulatory and reputational moat. And speaking of regulation, we absolutely can't ignore the government angle here. For a long, long time, the SEC was the boogeyman for all of crypto.
The regulation by enforcement era.
Yeah.
We all remember 2024. It felt like every single week a new lawsuit was dropping against some exchange or some project.
Right. It was a complete minefield. You didn't know what was legal and what wasn't. But look what happened in November of 2025. The SEC concluded an investigation into Ondo and took no enforcement action.
That is extremely rare. Usually when the SEC investigates a crypto project, it ends with a massive fine or lawsuit or both.
It ends with a settlement and a sad press release saying, "You neither admit nor deny wrongdoing. Here, nothing." That is effectively a no action letter in spirit, if not in a formal document. It completely clears the runway for them.
And you have to assume a firm like State Street saw that.
Of course. If you are the legal counsel at State Street, you do not partner with Ondo in January if you think the SEC is about to shut them down in February. Their legal team would have killed that deal in 5 minutes. That SEC outcome was a prerequisite for these big partnerships.
So the legal risk is dropping, the institutional integration is rising, and the TVL is exploding. But the token price is tanking because of the unlock.
You've summed up the paradox perfectly. But there's another really important layer here we need to talk about, the technology. Because I keep hearing that Ethereum, as much as we all love it, is just too slow and expensive for what Ondo wants to do next.
Right, they're moving to Solana.
They are. I saw this in the outline too. They are launching tokenized US stocks and ETFs on the Solana blockchain here in early 2026.
But why Solana? Is that just them chasing the latest hype, the hot new chain? Or is there a real technical reason for it?
It's purely about performance metrics. And this is where the TradeFi meeting DeFi narrative really gets down into the weeds. If your ultimate goal is to tokenize the NASDAQ or the S&P 500 or global bond markets, you cannot have 15-second block times like Ethereum.
And you definitely can't have $50 gas fees every time there's a popular NFT mint clogging the network.
Absolutely not. High-frequency trading requires high-frequency blockchains. It's that simple. Solana gives them 400 millisecond block times and transaction fees that are fractions of a cent. It is the closest thing we have in the decentralized world to a centralized exchange experience, like NASDAQ's own matching engine.
Okay, so the speed makes sense. But the notes also mentioned this new technology they're using called JIT minting.
Just-in-time minting.
Yeah, and honestly, the phrase simulator technology sounded a bit vague to me. It almost sounded like they were, I don't know, faking the transactions or something.
I can see why you'd think that. It does sound a bit like financial alchemy, but it's actually a pretty standard manufacturing and logistics concept that they've cleverly applied to finance. Let me give you an analogy.
Please do.
Think about the last time you used your debit card to buy a cup of coffee. You tap your card, the machine says approved almost instantly, and you get your coffee and walk out.
Right.
But did the actual $5 move from your bank account to the coffee shop's account in that 1 second?
No, of course not. The settlement for that probably happens overnight through the ACH system, or sometimes days later.
Exactly. The system gives you, the user, the feeling of instant execution while it handles the slow, messy, delayed settlement in the background. JIT minting is the exact same concept, but for tokenizing real-world assets.
Okay, so how does it work in practice for, say, a tokenized treasury bond?
So, in the old way of doing things, what we'd call pre-minting, the issuer, Ondo, would have to go out and buy $100 million of real treasury bonds, lock them in a vault with a custodian, then mint 100 million tokens, and put those tokens in a wallet waiting for you, the customer, to come and buy them.
So they have to put up all the capital first. That sounds incredibly capital inefficient.
Extremely inefficient. All that capital is just sitting there idle, dragging down returns. With JIT, just-in-time minting, the tokens are minted the very second you click the buy button.
But wait a second, we still have the T+1 settlement problem, right? The traditional banking system still takes a day to clear the cash and deliver the bonds. So if I get my token instantly, but Ondo doesn't actually get the underlying Treasury bond until tomorrow, who's holding the risk in that 24-hour gap?
Ondo is. Or more specifically, their network of institutional liquidity providers are. They are essentially fronting the capital. They verify your trade instantly on-chain, give you the tokenized asset, and then they handle the slow, messy background settlement with the banks over the next 24 hours.
So it creates the illusion of instant settlement for me, the user, even though it's still connected to the old slow rails.
Precisely. It makes the blockchain feel faster than the banking system, and it solves the huge problem of liquidity fragmentation. You don't need to have separate pools of idle cash sitting on every single blockchain.
Yeah.
A pool on Ethereum, a pool on Solana, a pool on Mantle. You just mint what you need, where you need it, exactly when you need it.
That sounds incredibly efficient, but also incredibly complex to manage, which I guess leads to the next logical step, the Ondo chain. They aren't just content being an application on Solana or Ethereum anymore. They want to build their own highway.
They are launching their own layer 1 blockchain, the Ondo chain. And this makes perfect sense if you think about it from a compliance and institutional readiness perspective.
How so?
Solana is permissionless. That's one of its greatest strengths. But it also means anyone can build a meme coin casino right next to your institutional grade tokenized treasury bond.
And Goldman Sachs might not like the neighborhood.
Precisely. If you are Goldman Sachs or BNY Mellon, you do not want your multi-billion-dollar asset sitting in the same block as a transaction for a token called Dog with Hat. It's a reputational risk. An institutional-grade chain, like what Ondo is building, can enforce rules at the validator level.
What kind of rules?
They can program the chain to say, to validate a transaction on this blockchain, you must be a known KYC'd regulated financial entity. It allows them to build a walled garden specifically for Wall Street assets away from the chaos of the public chains.
So they're building the venue itself, not just the securities that trade on the venue.
They're building the entire vertical stack. The asset, which is OUSG, the bridge to connect all the other chains, which is the Ondo bridge, and now the venue, the Ondo chain. They want to own the whole pipeline.
This sounds incredibly expensive to build and really expensive to maintain. Which brings us all the way back to the token. We have all this incredible value being built, all this infrastructure, but we also have 1.9 billion new tokens that just flooded the market. So let's get out the crystal ball. We have some price targets for 2026 that range from 20 cents on the low end to over $4 on the high end. That is a massive, massive spread.
It's the entire spectrum of possibilities. It's the difference between the narrative that the unlock wins and the narrative that the adoption wins.
Okay, let's start with the pain. What's the bearish view for the rest of 2026?
The bearish view is that the market simply cannot digest this new supply yet. The technical model suggests that we chop sideways or even bleed slowly in this 30 to 60 cent range for the entire first quarter, maybe even the first half of the year.
It's just dead money.
Or worse, if that big whale we talked about finally panics and sells his entire position, or if Bitcoin takes a nosedive and drags the whole market down with it, we could easily see a flush down to 20 cents. That's the capitulation zone.
That's where everyone who bought the story finally gives up, because the chart just looks too hideous to hold anymore.
Exactly. It's the point of maximum pain.
Yeah. Okay. But if we survive that, if the market manages to chew through all that sell pressure, what is the bull case for the end of the year?
The bull case relies on what we'd call a repricing event, a moment where the market wakes up and realizes the fundamental value. If the market starts to believe that Ondo is actually going to capture even a tiny fraction of the global treasury market, the models point to a recovery, an average price of around $1.73 by the end of 2026.
That's a 5 or 6x from where we are today. That's a serious recovery.
It is. And if we get a true crypto mania, a full-blown bull run where everything is going up, some of the more optimistic targets are sitting as high as $4.15 for the end of this year.
Okay, I have to ask you about the big one, though. The $10 prediction. I see this all over social media. Ondo to $10 by 2030. Is that based on any real math, or is that just pure hopium from bag holders?
Size. It's plausible math. It's not impossible. But you have to squint a little bit. And you have to assume they win. You have to assume they execute perfectly.
Okay, make me squint. What's the math that gets you to $10?
All right. The U.S. Treasury market, just the U.S. government bond market, is about $27 trillion. It is the biggest, most liquid market in the entire world.
27 trillion.
Okay. If Ondo manages to capture Just 0.1% of that market.
0.1%. That's a tiny sliver.
It's a crumb. But a crumb of a $27 trillion market is $27 billion in total value locked.
Wow.
So if you apply a standard valuation multiple that you'd give to a fintech company or an asset manager to a protocol that is managing $27 billion in assets, you can absolutely justify a token price in the range of $6 to $9. $10 is within the margin of error there.
So they don't need to eat the whole world. They literally just need a few crumbs off the biggest table in finance.
A crumb of the bond market is an absolute feast for a crypto token. That's the asymmetry of the bet you're making here.
But then I saw some of these wild predictions. For 2040 or 2050, people talking about $100 or even $500 per token.
Okay, let's pump the brakes a little bit there.
I had a feeling you're going to say that.
I have to be the voice of reason here. For Ondo to hit $100 with its total supply, the market cap would need to be absolutely astronomical. We would be talking about a valuation larger than some of the biggest banks in the world are today.
So not impossible, but highly improbable.
Is it impossible? No, I guess not. If the entire global financial system tokenizes itself and moves on chain, and Ondo becomes the default rail for that. But we shouldn't be banking on these hyperinflationary moonshot scenarios. We need to focus on the actual execution over the next 2 to 3 years.
Right. It's better to focus on the blue chip growth narrative, not the meme coin explosion fantasy. But even getting that crumb of the market is going to be incredibly hard. And this brings us to the so what section. Why are we talking about this today, on January 31st? Why is this urgent?
Because in 3 days, the entire roadmap, the entire narrative might change. February 3rd, the Ondo Summit in New York.
And as we said, this isn't just a crypto meetup in someone's basement.
No, this is effectively the coming out party for the institutional real-world asset industry. We've confirmed attendees from BlackRock, from Goldman Sachs, BNY Mellon, the DTCC, and the White House.
The White House presence is the real wild card for me. Why are they there? What is their angle?
That is the big question, isn't it? Are they there to embrace this new technology, or are they there to surveil it and figure out how to regulate it? But here's the interesting counterintuitive angle. Tokenized treasuries are actually great for the US dollar.
Explain that. That seems backwards.
Well, you hear all this talk in geopolitical circles about de-dollarization. China, the BRICS nations, they all want to move away from using the US dollar for global trade.
Right.
But stablecoins and RWA projects like Ondo are creating a massive new source of demand for US debt. They are some of the biggest buyers of short-term U.S. Treasury bills. It creates a new digitally native source of demand for the dollar. It reinforces the dollar as the reserve currency of the internet.
That's a fascinating angle. Usually crypto is seen as this anti-dollar or anti-government movement. But what you're saying is that Ondo is actually hyper-dollar.
Exactly. The White House and the Treasury Department might be realizing that the best way to ensure the dollar's global dominance for the next century is to digitize it. And if Ondo is building the best platform for that, then the government suddenly becomes an ally, not an enemy.
That would be a complete paradigm shift from the narrative of the last few years. And then there's the macro environment to consider, specifically interest rates.
Right. The reason Ondo's products are so attractive right now is because they yield 4 to 5% because the Fed's interest rates are high.
But the consensus is that the Fed is going to start cutting rates at some point in 2026. What happens if yields on these products drop to, say, 2%? Does the entire product just die?
That is the big risk. The question becomes, why go through the hassle and the perceived risk of crypto just to earn 2%? But the counter-argument is this concept of collateral utility.
Collateral utility. Break that down for us.
Institutions, especially big trading firms, they don't just buy treasury bonds for the yield. They buy them to use as poker chips in the global financial casino. They post them as margin for their derivatives trades. They use them to secure loans.
It's pristine collateral.
It's the best collateral in the world. So even if the yield on a tokenized treasury is 0%, the ability to have a pristine AAA-rated asset that you can teleport anywhere in the world in seconds, 24/7, is incredibly valuable. The utility isn't just the yield, it's the speed and accessibility.
So the plumbing itself is valuable, even if the water pressure, the yield, drops a little bit.
Exactly. The pipes are the real value proposition here.
Okay, so bringing it all back home, we have this massive, undeniable conflict, short-term pain, the supply unlock, the crashing price, the underwater whales selling every rally, versus long-term gain.
Yeah.
The institutional integration, the record-breaking TVL, the regulatory clarity, and this massive summit just days away.
It is the ultimate test of an investor's conviction. Do you believe the story the chart is telling you today, or do you believe the story the company is building for tomorrow?
It really feels like either a trap or a gift, and it just depends on how you look at it. Yeah. Is this drop to 28 cents a falling knife that you should avoid at all costs because there are still hundreds of millions of tokens waiting to be sold? Or is this a rare opportunity to buy a foundational piece of future financial infrastructure at a massive discount right before the Wall Street machine fully plugs in and takes over?
That is the decision every single listener has to make for themselves. But I will say this. When you look at the caliber of partners that are getting involved, BlackRock, State Street, Goldman, they aren't playing for a quick flip next quarter. They are playing for the next decade.
And here's a thought that I want to leave everyone with as we wrap up. We are looking at a future where the stock market never closes.
Yeah.
No more 9.30 to 4.00. No more weekends off. Money truly never sleeps. If Ondo is building the plumbing for that future, does the price of their token today matter as much as the volume of dollars that will be flowing through it tomorrow?
If they successfully become the pipes for trillions of dollars of global assets, the value will accrue back to the token. It's just a matter of time and execution.
Well, I know what I'm going to be doing on February 3rd. Are you going to be watching the summit live stream?
Absolutely. I've got my popcorn ready. I really want to hear what the person from the White House has to say about tokenization. I want to see the body language on stage between the crypto natives and the old school bankers.
It is going to be absolutely fascinating. We will definitely be back to break it all down after the event. Until then, be careful with that falling knife out there, but don't take your eyes off the plumbing.
Stay curious, everyone.